Have you ever pondered why investing is important for your financial future? It's a question that prompts us to consider the vast possibilities that lie ahead. Investing, in its core essence, is about making your money work for you. It's about planting seeds today, so you can reap the benefits tomorrow, and for many tomorrows to come. Investing is like a powerful engine that can propel you towards your financial goals, be it buying a home, planning for your child's education, or securing a comfortable retirement. It's a journey that can take you from where you are now to where you want to be. Now, you might be wondering, isn't saving enough? Well, saving is a crucial part of personal finance. It's like building a safety net. But here's the thing. Saving alone might not get you to your financial goals as quickly or as effectively as you'd like. This is where investing comes into play. It's like stepping onto an escalator that can accelerate your journey towards financial security. When you invest, you're not just storing your money away, you're actively seeking to grow it. You're using the power of compounding, the process by which your earnings generate even more earnings, to multiply your wealth over time. Imagine this. If you were to save $100 every month without investing, after 20 years, you'd have $24,000. But if you were to invest that same amount every month with an average annual return of 7% after 20 years, you'd have more than $50,000. That's the power of investing. Yet investing is not without risks. It's like sailing on the sea. There will be calm days and there will be storms. But by learning to navigate these waters, by understanding the principles of investing, you can significantly increase your chances of success. So, let's embark on this journey together. Let's dive into the world of investing and discover how you can harness its power to secure your financial future. Remember, investing is not just about making more money, it's about securing your financial future and achieving your dreams. Investing might seem complicated at first, but once you understand the basics, it becomes much more manageable. Let's start with the fundamental aspects of investing. First up, we have stocks. When you buy a stock, you're buying a piece of a company, becoming a partial owner. If the company does well, the value of your stock increases and you can sell it for a profit. However, if the company doesn't do so well, the value of your stock may decrease. Next, we have bonds. A bond is like an IOU. You're lending money to a company or government, and in return they promise to pay you back with interest over a set period. Bonds are generally considered safer than stocks, but the potential return is also lower. Then there are mutual funds. A mutual fund is a pool of funds collected from many investors for the purpose of investing in stocks, bonds, or other assets. It's like a basket of different investments managed by professionals. The beauty of mutual funds is that they allow you to diversify your portfolio without having to buy each individual investment. Now let's talk about risk and reward. In the world of investing, higher potential returns often come with higher risks. That's why it's important to balance your investments between high and low risk assets. This is where the concept of diversification comes into play. Diversification is essentially not putting all your eggs in one basket. By spreading your investments across different types of assets, you reduce the risk of losing all your money if one investment doesn't perform well. It's a way to protect your portfolio from the ups and downs of the market. So, there you have it. Stocks, bonds, and mutual funds. Risk and reward. Diversification. These are some of the fundamental aspects of investing. Understanding these basics sets you on the path of smart investing, paving the way for financial growth. Now that you comprehend the essence of investing, how do you actually get started? Step 1 in your journey to financial freedom is setting your financial goals. These goals define your investment journey. Are you saving for a new car, a dream vacation, or perhaps retirement? Your goals will determine the time horizon for your investments and can influence the types of assets in which you'll invest. Remember, the longer the time frame, the more risk you may be able to take on. Now, on to step 2, creating a budget. This is the financial blueprint that will guide your investment decisions. It's about understanding where your money comes from, where it goes, and then planning and prioritizing how you're going to spend it. You'll need to account for your income, your expenses, and the amount you're willing to set aside for investments. Be realistic and honest with your budgeting. Step 3 is to start small. You don't need a mountain of money to start investing. In fact, you can start with as little as the price of a lunch out. The important thing is to start. There are plenty of platforms and apps today that allow you to invest small amounts of money, and many even offer fractional shares of stocks. meaning you can buy a portion of a share for a company whose full share price might be out of your reach. Which leads us to step 4. Gradually increase your investments over time. This is where the magic of compound interest comes into play. As you earn returns on your investments, those returns then get reinvested and can earn returns of their own. It's a snowball effect. As you get more comfortable with investing and as your financial situation improves, aim to increase the amount you're investing. Lastly, let's talk about the importance of regular investing, also known as dollar cost averaging. This strategy involves regularly investing a fixed amount of money, irrespective of market conditions. This could be weekly, monthly, or quarterly, depending on what works best for you. The beauty of dollar cost averaging is that it mitigates risk by spreading your investments over a period of time. When prices are high, you buy fewer shares, and when prices are low, you buy more. Over time, this can reduce the average cost per share of your investments. Now, these steps may seem simple, but don't underestimate them. They are the building blocks to a sound investment strategy. And remember, the journey to financial freedom is not a sprint, it's a marathon. It takes time, patience, and discipline. Remember, the key to investing is starting early and staying consistent. So get started, stay the course, and watch your wealth grow. While investing can bring substantial rewards, it's also crucial to be aware of common pitfalls. Investing is a bit like navigating a ship through stormy waters. You need to know where the hidden rocks are to avoid them. So, what are some of these hidden dangers in the world of investing? First up is the trap of trying to time the market. Many novice investors believe they can predict market highs and lows, but here's the truth. Even seasoned professionals struggle with this. The market's movements are influenced by a myriad of complex factors, many of which are unpredictable. Instead of attempting to time the market, focus on a long-term, consistent investment strategy. Second on our list is the mistake of not diversifying investments. Putting all your eggs in one basket is a risky move. If that one investment tanks, you could lose everything. Diversification helps to spread risk across a range of investments. It's a bit like a buffet. You get to sample a variety of dishes, and if one doesn't taste good, it won't ruin your entire meal. Thirdly, never invest money you cannot afford to lose. It's tempting to pour all your savings into an investment that seems promising. But remember, there's always a risk. Always keep a safety net of funds that you can fall back on in case of an emergency. Lastly, many new investors fall prey to impatience. Remember, investing is a marathon, not a sprint. It takes time for investments to grow and bear fruit. Don't let a slow start discourage you. Stay the course, and with patience and persistence, you'll see progress. So, there you have it. Avoid the temptation to time the market, diversify your investments, never invest what you can't afford to lose, and practice patience. These are the 4 cardinal rules to steer your investing ship clear of the rocks. Avoiding these mistakes can help ensure your investing journey is a successful one. Let's quickly recap the key points we've discussed today. We've delved into the power of investing, which is more than just a way to make money. It's a tool that can help you reach your financial goals, whether that's buying a house, starting a business, or retiring comfortably. We've also broken down the basics of investing, from understanding different types of investments to the importance of diversification. Remember, don't put all your eggs in one basket. Then we took a step-by-step journey through how to start investing. It's not as intimidating as it may seem. With the right knowledge and a little bit of courage, you can take that first step. We also discussed some common mistakes to avoid, like not having a clear investment goal or letting emotions drive your decisions. Keep these pitfalls in mind as you navigate your investing journey. Remember, investing is a journey, not a sprint. Start early, stay consistent, and watch your wealth grow over time.